Have you ever stared at your portfolio on a really crazy trading day, watched those prices swinging wildly, and just wondered, who is actually creating these massive waves? When the stock market ocean starts to churn, it's almost never us everyday retail investors making those big splashes. Nope. We're out here swimming in currents that are controlled by completely invisible market whales. And to navigate safely? Well, you've got to know exactly who these giants are and, more importantly, which direction they're swimming. Welcome to This Explainer. Today, we are diving deep into the battle of the market titans, decoding FII and DII data. We're going to unmask the massive institutional momentum that actually drives the markets. We'll decode this daily tug of war between two very specific types of financial heavyweights: foreign institutional investors and domestic institutional investors. By getting a grip on their data, we can stop guessing and start tracking the actual footprints left by the absolute smartest money in the room. So, here is our roadmap for today. First, we'll meet the market titans. Then, we'll look at why you should track institutional money. After that, we'll break down the July 2026 data snapshot, unpack market volatility and the VIX, and finally wrap up with what this all means for you.
Okay, let's dive right into this. Section 1, Meet the Market Titans. So our whole market ecosystem is essentially anchored by two massive primary forces. On one side, you have your FIIs, foreign institutional investors. Think of this as the overseas capital that just pours into the Indian market. On the exact opposite side, you have your DIIs, domestic institutional investors. These are our homegrown financial heavyweights, basically acting as the local counterweight to all that foreign money. Now, to really grasp the sheer scale of FIIs, you have to realize we aren't just talking about a few wealthy individuals here. Oh no, we're talking about massive sovereign wealth funds deploying actual government surplus reserves. We're looking at gigantic global pension funds pooling employee money and massive foreign mutual funds that specifically target emerging market growth. This is global capital at its absolute peak. But then, contrasting all that foreign influx, DIIs provide this incredibly powerful domestic counterforce. This is the financial muscle of our local domestic banks. It's the mutual fund houses managing immense pools of investor wealth, and major insurance companies systematically taking premium collections and routing them straight into the equity market. They are an absolute powerhouse. Moving right along to Section 2, Why Track Institutional Money?
Tracking these institutional footprints is literally like having a cheat code for understanding the market's underlying health. By keeping tabs on FII and DII data every single day, you achieve three huge things. First up, you track broader market sentiments. You get to see what the big players actually believe, right? Not just what the daily news cycle is screaming about. Second, you understand the market makers. Because their trades are so incredibly massive, their buying and selling actively impacts where prices go. And third, it supports your strategic decision-making. So instead of just blindly reacting to some sudden price drop on your screen, you get a much broader view of exactly why those changes are happening.
And this brilliantly illustrates the core philosophy of tracking institutional flow. Honestly, it all comes down to this one simple truth. When money flows in, it usually reflects confidence. When money moves out, it suggests caution. It's basically the ultimate lie detector test for the entire economy. You just can't fake billions of rupees moving in or out of the market. All right, let's escalate from the foundational theory to real-world application. Section 3, the July 2026 data snapshot. Let's look at the incredible tug-of-war we witnessed on July 16, 2026. The contrast here is just staggering. Foreign institutional investors were heavy net sellers in the cash segment, yanking out a massive 4,205.56 crores. But look at what happened next. Domestic institutional investors stepped right up to the plate, injecting roughly 2,986.41 crores to completely absorb that shock. It's a classic heavyweight bout right there on the trading floor. So the really crucial point here is revealed when we zoom out from just that single day and look at the month-till-date trend for July 2026. This is where the story gets absolutely fascinating. Over the course of the month, FIIs were net sellers to the tune of 4,170.46 crores. But check out the domestic response. DIIs didn't just match them, they utterly overwhelmed them, net buying a staggering 20,056.12 crores. Wow. This highlights the sheer, incredible volume of domestic capital that is currently anchoring our market, acting like a giant shock absorber against foreign pullouts. Section 4. Understanding Volatility and VIX. 1288. That is the exact number the India VIX index dramatically dropped down to. If you're not familiar, the VIX is often called the market's fear gauge because it measures expected volatility. To put that 12.88 number into perspective, the India VIX actually fell 2.94% to reach that level, easing volatility after a pretty sharp spike we saw earlier in the month around July 8th. Things just rapidly cooled off amid stable equities and the ongoing earnings season. So let's connect the dots here. Despite the heavy multi-thousand crore foreign selling we just looked at, consistent and overpowering domestic buying has actively crushed market volatility. The DIIs provided so much liquidity and support that the market simply didn't panic. The fear gauge actually went down, even as all that foreign money went out. We've definitely covered a lot of ground today. Let's bring it all home. Section 5. What this means for you. Just look at how this data builds a hyper-condensed, immediate trend that you can actually use in your own trading. Over a quick 4-day stretch from July 13th to July 16th, we see a totally distinct pattern. Every single time FIIs dumped capital, whether it was 700 crores or over 4,000 crores, DIIs immediately stepped in to offset it. This data acts like a map for us. It proves you absolutely don't need to panic sell during foreign pullbacks because our domestic whales are actively out there providing a massive safety net. Which brings us to the ultimate question you really have to ask yourself every time you check your portfolio. Are you swimming with the whales, or are you just fighting the current? By tracking daily FII and DII data, you're no longer just guessing in the dark. You are reading the actual market mechanics at play. This data is published every single day, and these titans are always making their moves. So, the question is, how will you read tomorrow's market waves? Thank you so much for joining me for this explainer, and I really look forward to exploring more market truths with you soon.